Bring in Ellen Hazen, Chief Market Strategist and Portfolio Manager at FL Putnam Investment Management. Ellen, good morning.
Good morning, Mike. Thanks for having me.
Where do you see things here? I mean, it seems as if the soft landing is pretty much a consensus, at least if we look out, let's say, into the middle of next year. The markets might arguably reflect that already. We were up 2.5% in the S&P last week, down only modestly in August. How do you think that presents itself to you as an investor going into the fall?
Well, there's no question that the market has front-loaded a lot of the improvements that we're seeing in the economy right now. So if you look at the first half of the year, you saw massive multiple expansion across the S&P 500, led particularly by those big tech stocks, but also across the broader index as well. And we really think that was like a rocket, right? The market rocketed up, and that was the first stage. And the question is there a second stage? And we think that evidence is increasingly mounting that there is a second stage. If you look at earnings estimates, if you look at second quarter earnings results, if you look at the labor market that you were just talking about, if you look at various Atlanta GDP, other measures, it does look as though earnings and the economy are reaccelerating into the back half of the year compared to what people had thought before. And that may very well support the market. The market does not usually decline when the incremental data point is positive.
Yeah, it's interesting to frame it that way. When you look at the valuation expansion, so the PE of the market has gone up over the course of this rebound this year. Well, you have to remember we did have an earnings downturn, a modest one, but you did see year-over-year declines in earnings. Now, if those are firming up, I mean, you kind of had the earnings recession, and then the market leads the recovery in earnings. At least that's the bullish case. What could get in the way of all that? You still see a lot of folks focused on the potentially lagged effects of what the Fed has already done, the fact that we have seen a deceleration in the labor market, and even to some degree in pockets of consumer spending.
Well, one of the things that we've been focused on is the fact that earnings estimates are going up now. If you look at Q2, earnings estimates were supposed to be down 9%, and they ended up down 5.5%. Similarly, if you look at earnings estimates over time, they typically go down, 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 down because the analysts start off too optimistically, but they've actually ticked up a little bit the last few weeks. Now, this is not enough to make a trend yet, but it is encouraging. What could get in the way of this? I think a sustained hiking program. So if the Fed hiked in September and again in November, in the absence of materially higher inflation, that could certainly get in the way of it. But I agree with you, Mike, that the market correctly predicted that the earnings recession was going to be fairly shallow. And so from here, what you need in order for that to continue is for earnings to continue to grow. And if you look at the jobs numbers, yes, it's been decelerating for a while, but the last three reports have been up, up, up. So as we look at the overall market, it looks as though we're avoiding a recession, at least for the moment, and the earnings recession looks like it is fairly shallow. One last point on the earnings that we look at, if you look at where the earnings estimates increased most after the second quarter reports, it was in those pro-cyclical sectors. It was in tech. It was in consumer discretionary. And to us, looking under the surface at that tells us that, in fact, the economy is reinvigorating itself.
I'm interested that among your individual stock picks are some housing related, D.R. Horton as well as Sherwin-Williams. Do we not need longer term bond yields and mortgage rates to come down for that trade to work?
I think we need them not to go up anymore. There's no question that housing is much less affordable than it has been. We've all seen the 30-year mortgage rate. But there is still a structural shortage of housing here. D.R. Horton, as you know, focuses on the first-time buyer. And with the stronger jobs numbers, and importantly, as you noted earlier in the segment, more people entering the labor force, more people have money enough to buy houses. And we think that at this valuation, you don't need a lot to go right for that. You just need things not to go wrong. And so I would say if we saw another 50 or 100 basis points higher in the 30-year mortgage, that could put a dent in it. But beside that, you're looking at a company with very low leverage, with high optionality on land. That could be $150, $160 stock. They can earn $16 a share in a couple of years if rates don't go too much higher from where they are now.